Hello there, and welcome to Business Basics, a podcast designed to give some information about how financial markets work and various accounting practices in order to give you the tools to make smarter financial decisions. Whether you're looking to learn something brand new or just want a refresher on some basic economics, there's a place for everyone on our podcast. I'm Archit Janarkar, and I'm your host. Today's episode is going to be a shorter episode, and it's going to focus on the concept of short selling. Short selling is the exact opposite of purchasing and then selling a stock. When you buy a stock, you expect and hope that it will go up. That way you can sell at a price that is more than what you bought it for. And in this process, you buy a stock first and then you sell it. Well, in short selling, you end up selling the stock first and then you buy it. But you may be thinking, wait, how can I sell something if I don't have it in the first place? And what happens when you short sell is you borrow the shares from a broker or someone who already owns that stock. Let's say that I decide to short sell against Tesla. I borrow however many shares of Tesla I want to short, maybe 5 for this example. As of today, Tesla is trading the upper 700s, around $710 per share. I borrow 5 shares of Tesla from someone who already owns Tesla stock. Then I go and sell those 5 shares to another person, a third party. That person then gives me 710 times 5, is $3,550 in exchange for Tesla stock. Now, what I'm hoping for is Tesla stock to go down, which is the exact opposite of buying then selling. Because say then that Tesla's price goes down to 700. What I can do is buy those 5 shares back, and to do that, I pay 700 times 5, $3,500 to that person. But keep in mind, I have to pay the original person who I borrowed the shares from for using their stock. So I pay them $3,500, completing the transaction. And you'll recall that I sold the stock for $3,550 and bought it for $3,500. I can then pocket that $50 difference as my profit. This is a neat way for a person to make money during recessions. If you saw what was coming with the coronavirus pandemic and the effect it would have on the stock market, you could have chosen to short sell and made a lot of money. In fact, there's an investor named Bill Ackman who made around $2 billion doing just that. Now, the downside to short selling is that your losses are technically infinite. If you put a $10,000 investment into a company, and the company then goes bankrupt, your investment could go down to zero. But if you short sell a company, but its stock happens to do well, you'd still be required to come up with funds to repay back the stock's price. If Tesla suddenly went up to $1,500, I would have to come up with 1,500 times 5, $7,500. And that $3,550 I originally sold it for won't cover that. So that's the downside with short selling. If you liked that episode, please like, subscribe, and leave a review for our podcast wherever you get your podcasts from. If you want interesting business reads and articles selected by me, sign up for a newsletter, which you can find by going over to our website, businessbasics.online. We're also going to be starting a blog on our website pretty soon, so keep a lookout for it when it's released. Check out our social media as well. We're on Instagram and Twitter with the handle @BBusinessBasics. I'm Archit Janarkar, and thanks for listening.